Greetings, everyone. My name's Ben Drucker. This is my first video ever on YouTube, and let me introduce myself first. So I am 46 years old. I'm a dad. I live abroad in Taiwan right now, but based in the United States still. I will probably come back and edit this video, or at least amend certain parts of it. We'll see. But if you're anything like me, you've been watching and consuming tons of YouTube content, trying to figure out if you can make trading a lifestyle for you and have it pay all your bills and eventually, set yourself free from a 9-to-5 job, or really just enable you and or your loved ones to have a life that you want instead of what other people are going to dish out to you. So, that's where I'm coming from, and I've had a lot of folks that I listen to on YouTube, watch on Twitter or X, and I've basically formulated my own trading framework based on a lot of different content that I've amalgamated into a framework that works for me, and I'm hoping to put out my analyses, hoping that in some respects it might help some of you take trades that I miss, because my bias is often correct. I'm just a little too early or too late and miss it entirely, and my risk parameters don't let me enter. But if there's something in here that helps you see the markets differently or in a way that will help make you money and potentially make that dream come true of being free from financial burdens, then that's what I'm aiming to do here. Give you my analysis, my takes on many different markets, and hopefully that we can, grow together as a community. Let's see. I, being 46, so 30 years ago, really got interested in stocks and investing, fundamental research and whatnot, and picked a few winners, got lucky, looked into learning options and things like that. So, 30 years of financial market interest, but never really thought much of trading, day trading, that there was a real technical aspect to the market until relatively recently. So 5 years into real trading now. I blew several thousand in Forex on a completely ignorant foray there, maybe 15 years ago, where I had no idea what I was doing. I just heard a random tip like, hey, the Brazilian real is going to be really strong. The economy is doing great. I was like, okay. So I bought into the Brazilian real, got blown out because I just didn't understand leverage, didn't understand any of the shenanigans going on in Forex markets back then. I understand a lot more now, and I do understand a lot more of the technical aspects of the market. I'm generally profitable these days. That said, I can show receipts totaling probably 30,000 or more from prop firm payouts. I've also spent plenty on challenges and blown accounts, so I'm not going to be sugarcoating or trying to convince you that I'm a master trader yet, but I surmise that I could get there soon. But these days I'm blowing far fewer accounts, evals, and funded accounts, and I'm managing to take a lot more frequent payouts. So that to me says I've turned a corner, I believe. Getting there was definitely a struggle, and I still have like these massive red blow up days that I just wish didn't exist. But I'm here to tell the truth, be open and honest, not kind of, be open and honest, and try to give you analysis and real talk where it matters. So let's get a basic trajectory here. I, like you, have probably consumed hours and hours of YouTube content from several different people trying to find something that makes sense. So, that's where I do believe if you can find a system, backtest it, make a framework, and you have faith in that with a positive expected value, you really don't need to do much else. You don't need to system hop. You don't need to, go to the next best thing. You don't need to have a signal service. The idea is to become an independent analyst and be able to make decisions with proper risk that you can live with day to day and know that some are wins, some are losses. That's how it goes in trading. But yeah, I've watched hours and hours of YouTube. I've read thousands of Twitter posts, etc. Gurus and all the hype of buy this metal now, get out of this stock, or make sure you buy gold before it's too late. All those hype headlines and things. I'm not going to be trying to do a bait you into watching my videos and things. I hope not. I don't. If I get there, please remind me that this video exists and I need to back off. Finally, a disclaimer: I'm not a financial advisor. I'm not inducing you to buy or sell any asset or instrument. You do your own research and consult someone qualified on your behalf to advise you financially. This is for educational purposes, and I'm providing my analysis. And there we go. This being my first video, I'm taking a super macro look at a few assets, and you can see the dollar index here on my screen on a monthly time frame. So that's where I'm going to start. I will give some credit here to a few of many of the people that have shaped my financial market analysis, and in no particular order of relevance, because I use many pieces from many people that I've taken content from and put them into my own framework. So you'll see Wyckoff, you'll see ICT, you'll see DR throughout my channel. You'll see things from Stoic TA, you'll see things from Ali Khan, dealing range theory, and a shout out to DGen Rehab, who's inspired me to start a channel and provide my analysis on the markets. Those are a few, and then some others that I've followed for a while, watched their content. I don't have anything specific that I bring in from them, but I just want to be open and transparent with who's been a part of my journey so far. So that list is in the comments or in the description, and I do thank them all for whatever contribution they have made to my journey, as we are all on a journey. So with that, let's look at the dollar index. I will say, primarily my basis and the most of my content consumption was from ICT. And so you will hear terms and things that I use from him. But let's say Ali Khan with dealing range theory kind of put the icing on the cake in terms of really solidifying an understanding of ICT and why and when PD arrays, premium discount arrays, will perform or will be high probability setups. So here is my monthly chart of the dollar index, and I'm going to unhide. Let's see. Shoot. Now it's all grouped together and it's not working. Group one. Oh, because I have all these hidden. Okay, let me hide that again. Here we go. Okay, so we have monthly views going back to 2016. I'm going to zoom in here a little bit. Okay, this is a weekly fair value gap, but transposed to a monthly time frame that I have on the dollar index. I drew this 3 years ago, thinking that at some point the dollar will spike into here and reject. Now, I waited almost 2.5 years for that to happen, and lo and behold, here it has done so below the consequent encroachment of this weekly fair value gap. And now we have formed a breaker with 3 up close candles, taking buy side liquidity and closing back below the initiation of that. So we have a breaker here. And we have now been consolidating for roughly a year between 100 and 96 on the dollar index, right? The bodies of these candles are really not budging outside of this range, 100 to 96. So what does this mean in the current context of things? Say the gold and silver run up, the war in Iran. To me, I'm bearish the dollar long term. and that's for many reasons. However, what I would expect to see is the end of April is approaching, so I would expect this candle to close on a down basis, so a red candle here. But we're not going to get another push to the downside without some liquidity taken on the buy side here for the dollar. So I would expect over the next month, 2 or 3, for this dollar index to push up above this wick into a premium of this leg and then tank. That's my overall macro prediction for the dollar. I think overall international alliances, countries are de-dollarizing, and I don't necessarily see the value in U.S. stocks and bonds that have been propping it up for a long time. It's not a doom and gloom story. Obviously, this has been 3.5 years basically consolidating here to rip and dump, been consolidating here for a month to potentially pump and dump some more to clear out these nice equal lows over here, and there happens to be a fat imbalance over here that is prime for the taking. So why do I think that now? I will now show these. Now, this might look a little messy, but these are the fib extension and retracement tools that I've used. And this is where Ali Khan and ICT have really come in to inspire me here. So when I measure this consolidation range and 4 standard deviations from the top of that, I know it says 5 up here, but that's because this is a 0. This is the range, and then 1 standard deviation. 2 would come to here, 3 is here, and 4 standard deviations. So several of my mentors, gurus, people that I have followed, have noted the market moves in 4 standard deviations, and lo and behold, that's exactly right here. This high of the DXY was 4 standard deviations of this measurement from this high of this red candle to the low of this green candle, this consolidation range. So 4 standard deviations up. This is likely the long-term high for probably the next 5 to 10 years, if you ask me. Which you probably didn't, but that's my analysis here. So we've now dropped down, we consolidated, we ripped back up into that weekly fair value gap that I marked out on a monthly time frame, never closed above it. And then if we are to measure the range from this high to this low, which I've notated over here, okay, we have a 75% dealing range, which these bodies of these candles on a monthly basis are not closing above 75 DRT level, dealing range theory, DRT level, within the fair value gap that has inverted, right? So we have a bullish and then a bearish imbalance. That's an inversion fair value gap. We've wicked into it, and we are not closing candles above 75% of this dealing range. So that to me signals a bearishness. However, in this dealing range, we are in we're consolidating in a bit of a discount, right? We've nicked the 25%, which is the lowest quadrant in extreme discount. And we have yet to reapproach the 50% after this wick happened here. So when we are taking this consolidation, it is, in my experience of the market, unlikely to just drop off. Possible, unlikely. What is more likely to be seen is that currently countries and whoever need to get some liquidity, which is going to, for the short term, force them into the dollar, because that's still a reserve currency where transactions are, people need dollars to transact. Again, I don't see that being a longer term solution for world finance, but who am I to say? However, the narrative kind of makes sense, where people are going to have to, liquidate things and get dollars back to kind of close out a lot of their books and things over the next several months, years. So I do see a demand for dollar coming up here above, say, the 50% here, which is right above this wick. this consolidation, I don't think we'd want to see a monthly close kind of above half of that consolidation. If we take some of Stoic TA's teachings about this, the swing break sequence, we have a break, a tap, or a break, a tap, and then we could get a double top in here around the 618. So if you are familiar with swing breakout sequence from Stoic, we could be looking at a retracement up to the 618, which is just above half of this consolidation range and within the premium fair value gaps here. So if I hide that again, see we have another inversion fair value gap here, and that 618 retracement falls right in there. So I see that as a high probability retracement from here to get up to the 618, which is in the premium of these two different imbalances on a monthly basis. It could just wick up there because that would be above the 50% of this consolidation range. I wouldn't want to see it get too much higher than that. It's possible we get back up here and tag the 75 DRT and kind of wick the body of this down close candle, but that would make me a lot less bearish on the dollar than if we come up here, get body closes below half of this consolidation, kind of wick up to the 618 twice, and dump. So that's my analysis on the dollar. Whether most people don't trade the dollar itself, they're going to trade euro, they're going to trade pound. I don't necessarily think gold. I have not been able to track a correlation between gold because it has nothing to do with the dollar, really. It's more of a store of value asset, and it dollar can go up, gold can still go up, and it's not it's not necessarily, it's just measured in dollars. It's not dependent on dollar, where the DXY is a basket of 6 currency pairs against it, which Aussie and New Zealand are not in that. So Aussie and New Zealand tend to follow more of the they really track with the indices pretty well. There's been a good correlation with the ES and the NASDAQ on the New Zealand dollar and Australian dollar, but that's for you to check on yourself. All right, so that's the dollar index and whether or not you would trade euro or pound against that basis. I'm short euro currently in my own swing account, and I'm targeting 112 for that. If I go over to my euro chart, I'm targeting at least the top of this range, 112. Really, 110 is my target for euro. May not get there, so I'll be trailing a stop way down here. And I know this is messy, but I'm just showing you right now that we've also not closed above the 75% DRT of this range for a while. Actually, I have this same fair value gap on the weekly basis noted here, and half of that aligns with 110. So I'm targeting 110, but 112 is, to me, a likely safe bet for a long-term hold on euro. And it's going to be a few months, but that's fine. Certainly short and waiting for that to happen. So back to DXY. All right, so now I'll just hide these. Many of you might ask, what would that mean for, say, gold and silver? Yeah, I do think gold and silver are going to be making another run up. They may consolidate while the dollar, if the narrative plays out while the dollar goes up, gold may consolidate here, drop one more time and back up. I do see that this wick from December and this wick from this month have pretty much touched. It's already swept the December low in March. And so this could well be the annual low. This would then be the second quarter low potentially, and we could just be going up or consolidate here, wick down and up again. If we're looking at silver, same thing. We've pretty much been able to fill this gap with a down closed body. Probably we'll get an up closed body at some point in the next 3 months. I don't see silver tapping much below 55 to 53. If it were to have one more big shakeout down, and then another run up with all the industrial demand that this commodity needs or is demanding. Oil, right? I mean, this has certainly been impacted by the war, but I'm not going into too much detail here. This is starting to feel like a smooth double top here, which could consolidate, dip, and rip to knock it out as the war in the Middle East continues. The stock indices, I do see this as a blow off top. Macro wise, I was expecting a drop, and then I was telling my dad just like a month ago, I wouldn't be surprised to see all the indices just rip higher, knock out all the stops above these clear, clean, rounded top highs, and then completely tank. Fundamentally, usually I'm not looking at fundamentals, but the profits and revenue just aren't there yet for all the hype that's gone into AI, for example. And so while these are nice, strong looking candles, I'm looking at volume here, and the month of April's volume making an entirely new high, where the down close candle before that in the month of March, this is where the Wyckoff theory would come in. This is a sign of blow off top that smart money's already positioned short, and this is now knocking everybody else out. This is the upthrust after distribution UTAD. And what I'm expecting is a little wick, another little wick, and a big red candle next month or the months following to get us way back down here. That's ES. The YM so far hasn't broken this high. I think it might still do so, but if it doesn't, then that's extra bearish for me. That would be the smart money technique, time, tool, whatever, in terms of a divergence where the NQ, the ES make a new high and the Dow does not. So that would be an extra confluence for bearish US stock indices. I also look at things like soybean oil, right? And soybeans themselves. I will eventually be bearish on both of these, even though they are commodities. They've been priced exceptionally high lately, and they've cleared out a lot of stops on the buy side here. When we look at monthly time frame, we're near all-time highs of soybean oil. We have almost filled a monthly gap here. If we wick the bodies of this, then I'm expecting a consolidation and a turnaround. So when I see a break down here, I'll look for a retracement and try to ride soybean oil down. Soybeans are looking even a bit more bearish. However, this clean double top is suspect to me. So I'm less engaged. I'm gonna wait and see if soybeans want to make a run up and clear this out for some reason. If there's some kind of disaster that will increase the price of soybeans, which would also affect soybean oil, then maybe this makes one more peak before it comes down. So I'm not shorting this yet, and I'm not longing it. I don't like exactly where we are, but I do have some alerts here. Let's see what else. Bond futures. So I was very bearish on bonds starting back. Here, even looking at here, it hasn't necessarily dropped yet. I do think we'll see a rise with the dollar demand, and I do see it as false demand. I think we'll probably do one more run up into this gap and sell side imbalance, and then we'll be tanking with the dollar. So there's kind of a lot of room to the downside and a lot of stops waiting down here. So that's my macro view on a lot of different assets and asset classes. Hope you found that informative. I will be getting deeper into weekly and daily and 4-hour, hourly analysis videos as well. But I wanted to get my foot in the door, get started out there, have some people comment, and get this channel started. So I appreciate your attention, and I will be talking to you soon. Thanks for watching.